Hey guys, Kevin Bupp here, and in this video we're going to discuss the differences between a deal-specific syndication and a fund model syndication. Now, simply put, a lot of the mechanics on the back end are very similar between a deal-specific and a fund model. The waterfalls can carry very similar characteristics. The pref, if there is one, can carry similar characteristics. The GPLP structure, what have you. They're really built on the same foundation. And so let's move on to the pros and cons, because that will give you a better outline of exactly what the real differences are. And how I'm going to approach this is pros and cons of the fund model versus a deal specific. And that will kind of give you an idea of what some of the, I guess, the benefits and downsides are of the actual deal specific model. And so let's get started with the pros of a fund model. In a fund model, you're typically investing in multiple properties, and so that offers diversification. Diversification for the investors amongst multiple different properties, as well as a lot of times multiple different markets. Whereas in a deal-specific syndication, it's one deal in one marketplace. So if something should happen somewhat drastic in that marketplace, let's say that a major employer leaves and moves their operations to a different country or different location, and a lot of jobs leave that area, that could have a significant impact to that one property. The same thing could happen in a fund model to that one property, but there might be 8 other properties that are helping prop up that one that might be having some challenges. And so I see that as a huge benefit in the fund model, that you are diversifying your money proportionally across multiple different properties and markets versus just one. One of the other big benefits of a fund model is the buying power. Quite often we have some liquidity reserves in place as we're doing our capital raise for the buying of the multiple properties that are going to be in that fund. And so if we ever get into a competitive bidding environment on one specific property, we can basically operate as a cash buyer. We typically put leverage in place, but a lot of times we'll put the leverage in place after we close on the property, and so we can very aggressively be a cash buyer, make the highest and best offer, and outbid or I guess be a much better option for the seller than that of someone that needs to put debt on place to close that property out. And so again, I see that as a huge benefit of a fund model versus a deal-specific syndication, where you're raising capital just for that one deal versus having some capital reserves in place that you can deploy and become a cash buyer. One of the other big benefits of a fund model is the ability to recapitalize the fund by either liquidity events that have to do with a refinance or a sale of maybe one of the individual assets within that fund, to where you can take that capital and redeploy into a new asset. So adding additional assets to that fund, which creates a, again, more diversified investment vehicle versus that of a deal specific, where again, you're only talking about one deal. There's no diversification there. All right guys, so we shared with you a lot of the benefits of the fund model. So let's talk about some of the cons or the downsides of a fund model. As mentioned, not every one of the properties that are going to be owned in that fund will be identified from day one. And so you being an investor, you might be investing in a fund that you might not absolutely know 100% which all properties you're going to have proportionate ownership over, okay? So there's some faith that's involved there, but more importantly, being an investor, you need to do your due diligence of making sure that you team up or partner or invest with a sponsor that has a proven track record, okay? Whereas in a deal-specific syndication, again, we're talking about one deal. That deal, it's known, it's presented to the investors, you can wrap your arms around it, you can understand it, you can review financials and projections, whereas that might not be the case with a lot of the properties that are going to be purchased in a fund. And guys, another downside of a fund model is if you partner or invest with a sponsor that doesn't have the ability to deploy your capital in a timely manner. And that typically equates to their lack of deal flow. You've got to be absolutely confident of being a sponsor yourself that's operating a fund. You have to be absolutely confident in your ability to create deal flow so that you can efficiently and responsibly deploy the capital that you've raised from your investors. In a deal-specific syndication, there's one deal. The investors know what that deal is, it's there, they're raising capital specifically for that one deal. So that is a much more efficient model than that of a fund with a sponsor that doesn't have a track record of operating funds. And so with that being said, make sure again, you do your due diligence and know who the sponsor is, you know they have a proven track record, they've done funds before, they've proven the concept, and they've executed accordingly. With that guys, that's all I have for this video. I appreciate you watching. I hope I brought a lot of value to you and your business. If I did, please like it, and I'll look forward to seeing you on the next one. You guys take care.